Comprehensive Analysis of Accelerant Holdings ARX. Through Warren Buffett's investment lens, one business quality and economic mode analysis, Accelerant Holdings ARX operates a data-driven risk exchange that connects specialty insurance underwriters, its managing general agents or MGAs, with risk capital providers, insurers, reinsurers, and institutional investors. Founded in 2018 by insurance industry veterans Jeffrey Lee Radke, Christopher Lee Smith, and Frank O'Neill, the company has developed a technology platform that streamlines the historically fragmented specialty insurance market. The company went public in July 2025 through a $724 million upsized IPO that priced at $21 per share, and surged 35% on its NYSE debut, reflecting strong market confidence in its business model. 1.1 revenue model and business operations. ARX generates revenue through a fee-based model that creates highly recurring revenue streams. Platform access fees, charged to both MGAs and risk capital partners for access to the risk exchange platform. Transaction fees, based on the volume of insurance premiums exchanged through the platform. Evaluated services, fees for analytics, operational support, and underwriting capacity provided to MGAs. The company's insightful technology platform provides advanced data analytics, AI-powered risk modeling, and real-time portfolio monitoring capabilities. As of March 2025, ARX's platform connected 232 MGA members with 96 risk capital partners across 22 countries, facilitating over 500 specialty insurance products. 1.2 Competitive advantages and economic moat. Proprietary data and technology. ARX's platform ingests, validates, and transforms data from its 200 members, creating unique data advantages through AI and machine learning capabilities. The company's risk indexing technology has demonstrated a 5.3% improvement in gross loss ratio for users. This technology edge creates switching costs for participants who become increasingly dependent on ARX's analytics. Network effects. The platform exhibits strong network effects as more MGAs join. The platform becomes more valuable to capital providers, and vice versa. This creates a self-reinforcing ecosystem that becomes increasingly difficult for competitors to replicate. The company has achieved a 217% compound annual growth rate, CAGR, in exchange written premium since inception, reaching $3.5 billion in trailing 12-month premium. High margin scalability. ARX operates with 68% gross margins. It's characteristic of software-enabled businesses rather than traditional insurance operations. This SaaS-like scalability allows the company to grow efficiently without proportional increases in costs. Regulatory expertise. Navigating the complex regulatory environment of specialty insurance across 22 countries creates significant barriers to entry for potential competitors. ARX's established compliance framework provides a durable advantage. Strategic expansion. The company has systematically expanded its capabilities through initiatives like Mission Underwriters MGA Incubator, Flywheel Reinsurance, Sidecar, and partnerships with established insurers like AF Specialty. Table ARX's economic moat assessment using Buffett's framework moat. Component ARX status assessment, brand value growing recognition in specialty insurance, developing technology edge, proprietary AI/ML risk modeling platform, strong network, X232 MGAs plus 96 capital partners across 22 countries, strong switching costs, integrated data analytics and operational support, moderate cost advantage, 68% gross margins. SaaS-like scalability strong despite these advantages. ARX operates in a competitive landscape that includes traditional insurance intermediaries, merging insurtech companies, and potentially large technology firms entering the insurance space. The durability of its economic moat will depend on maintaining its technological edge and continuing to expand its network effects. To management quality assessment. Warren Buffett places immense importance on the quality and integrity of management when evaluating investment opportunities. ARX's leadership team demonstrates several characteristics that align with Buffett's preferences for capable and trustworthy stewards of capital. Its founding team expertise. CEO Jeffrey Lee Radke and co-founders Christopher Lee Smith and Frank O'Neill are described as longtime insurance industry executives and technology experts who shared a vision of rebuilding how risk is exchanged. This combination of industry expertise and technological vision is valuable for navigating the evolving insurtech landscape. Strategic vision and execution. Management has demonstrated a disciplined approach to growth through strategic initiatives, including launching Mission Underwriters MGA Incubator in 2021, establishing Flywheel Reinsurance Sidecar in 2022, expanding into new markets Canada, Australia in 2023, developing new products like Sprouter Insurance, product development, and synthetic captives. These initiatives show strategic thinking about controlling more of the value chain and enhancing margins. Capital allocation strategy. Management has overseen a remarkable financial transformation, taking the company from a net loss of nearly $92 million in 2022 to a net profit of $27.2 million in 2024. The successful execution of the $724 million IPO demonstrates capital markets competence. Shareholder alignment. Altamont Capital Partners holds a 79.2% voting stake post-IPO, creating significant insider ownership that aligns management interests with those of shareholders. However, this concentration of control through a dual-class share structure may raise governance concerns for some investors. Transparency and communication. As a public company, ARX provides regular financial disclosures and has attracted coverage from reputable firms like William Blair. The company's presentation of detailed metrics like exchange written premium growth, 217% CAGR, and specific partnerships demonstrates transparency about business operations. However, some aspects might give Buffett pause. The company's relatively short operating history, founded in 2018, means management hasn't been tested through multiple economic cycles. Additionally, the dual-class share structure that concentrates voting power with Altamont Capital Partners reduces influence for public shareholders. 3. Financial strength evaluation. Warren Buffett prioritizes companies with strong financial fundamentals, including consistent revenue growth, healthy profit margins, high returns on equity, minimal debt, and strong free cash flow generation. ARX's financial profile presents a compelling but mixed picture when evaluated through these lenses. 3.1 Revenue growth and profitability. ARX has demonstrated exceptional revenue growth in recent years. Exchange written premium, 217% CAGR since inception, reaching $3.5 billion in trailing 12-month premium revenue, $652.5 million for the 12 months ending March 2025. Net income, $26.6 million for the 12 months ending March 2025. The company has achieved a remarkable profitability transformation. 2022, net loss of nearly $92 million. 2024, net profit of $27.2 million. Q1 2025, continued profitability. This trajectory from significant losses to sustained profitability demonstrates operating leverage and business model scalability.
5 long-term prospects and risks. Evaluating ARX's long-term potential requires examining industry dynamics, competitive positioning, and various risk factors that could impact the company's ability to compound capital over the next decade. 5.1 Industry outlook and growth potential. The specialty insurance market represents a substantial opportunity. Market size: $164 billion by 2029, growing at 10.7% CAGR. Drivers: climate change, cybersecurity threats, and emerging sectors like renewable energy and aerospace. Digital transformation. The broader insurtech market is projected to grow at 49.4% CAGR, reaching $162.12 billion by 2032. ARX is well positioned to benefit from these trends through its technology-enabled platform that addresses inefficiencies in traditional insurance distribution. 5.2 Competitive threat and market position. ARX faces competition from several fronts. Traditional insurance intermediaries, established brokers and reinsurers with existing relationships, emerging insurtech companies, digital native competitors with similar technology-focused approaches, large technology companies, potential future competition from tech giants entering insurance. ARX's competitive position appears strong due to its first-mover advantage in the data-driven risk exchange space, proprietary technology, and growing network effects. The company's expansion to 232 members and 96 capital partners across 22 countries creates significant barriers to entry. 5.3 Key risks and challenges. Several risks could impact ARX's ability to compound capital over the long term. Execution risk. The company must continue to innovate and execute effectively against larger competitors. Regulatory risks. Changes in insurance regulations across 22 countries could impact operations' data privacy concerns. As a data-driven platform, privacy regulations could affect business practices. Economic cyclicality. Insurance markets historically experience cycles of pricing strength and weakness. Valuation risk. Current valuation may already incorporate significant growth expectations. 5.4 Capital compounding potential. For ARX to compound capital effectively over the next decade, several conditions must be met. The company must maintain its growth trajectory while expanding profit margins. Network effects must strengthen as the platform scales, creating deeper competitive moats. International expansion must continue successfully without diluting returns. Management must maintain disciplined capital allocation as the company matures. If these conditions are met, ARX has the potential to become a much larger business over the next 5 to 10 years. However, the uncertainty around these factors makes the company's long-term prospects less predictable than established businesses. Buffett typically prefers
6. Final verdict. Buffett style, investment suitability. Based on comprehensive analysis through Warren Buffett's investment principles, here is how Accelerant Holdings measures up against each of the key criteria. A. Understandable business. ARX operates a technology-enabled insurance exchange, which is a reasonably understandable business model. However, the complexity of specialty insurance and AI-driven risk modeling adds some opacity. Rating. Moderately understandable, be consistent earnings. ARX has demonstrated a remarkable turnaround from losses to profitability, but its short operating history makes earnings consistency unproven. Rating not yet demonstrated. See good ROIC. While specific figures aren't provided, the company's high gross margins and capital-light model suggest potential for strong returns on capital. Rating. Promising but unproven low debt. Specific debt levels aren't disclosed. The recent $724 million IPO likely strengthened the balance sheet. Rating. Likely satisfactory. E. Attractive valuation. Traditional metrics suggest full valuation. Though growth prospects may justify premium multiples, Morningstar's $43.20 fair value estimate suggests significant upside. Rating. Mixed F long-term moat. ARX demonstrates several competitive advantages, including network effects, proprietary technology, and data advantages. However, the durability of this moat is unproven. Rating. Developing 6.1 overall assessment. Accelerant Holdings does not fully meet Warren Buffett's investment criteria at its current stage of development. While the business operates in a large addressable market and has demonstrated impressive growth in improving profitability.
Despite the short operating history, unproven earnings, consistency,
And valuation concerns make it unsuitable for a traditional Buffett-style investment approach. The company might be better suited for investors with a growth-oriented perspective who are comfortable with higher risk in exchange for potential future market leadership. Buffett would likely prefer to observe ARX for several more years until it demonstrates a longer track record of consistent profitability and strong returns on capital before considering an investment. For those interested in the insurance sector through a Buffett lens, potentially more suitable candidates might include established insurance companies with longer track records of profitability, stronger economic moats, and consistent returns on capital, though these would need to be evaluated based on their own merits. Against Buffett's criteria. Table, ARX, Buffett-style investment suitability. Summary criterion assessment explanation, understandable. Business moderate insurance exchange model, understandable, but with complexity, consistent earnings, poor short history. Recent transition to profitability, good, ROE, ROIC, unknown, not reported. Likely improving, but unproven low debt, likely good IPO strengthened balance sheet, specifics not disclosed. Attractive valuation mixed growth versus value perspective difference. Long-term moat developing network effects and technology advantages, but unproven. 8. Overall suitability not recommended fails to many key criteria for Buffett-style investment.